We've touched upon this already, but why are interest rates so important for Forex traders, and why do decisions about interest rates impact them so much?
Actually, this is a very interesting question, and lots of layers. First of all, as we said, interest rates are important because currencies are nothing more than cash. Cash earns interest when I put it on deposit at the bank, so I tend to want to put my money where the highest interest rate is, and that drives currency moves. Who sets these interest rates? That's central banks. Now, when people look at these currencies and they look at the relative value of transactional goods and the states of economies, these things don't change overnight. And central banks certainly don't all of a sudden have half a basis point or 50 basis points of interest, 0.5% interest rate, and then all of a sudden tomorrow they set it at 4% and the next day at 3%, and it's just all completely random stuff. So the underlying fundamentals don't have what you'd call volatility. They don't just bounce up and down. However, the currency market, when you look at, for instance, when a central bank comes out and makes an announcement, the thing can do this. So the interesting question is, yes, interest rates are important, but why is it that currencies react so violently to a policy shift? And you can have various models, thought models, mathematical models that try to explain that. And so the way to think about this is following. We said that there is the notion of an intrinsic value of a currency, which is sort of a long-term effect, 3 to 5 years. And so that means that people have a perspective that over the next 3 to 5 years, the currency should sort of average to that level. However, over the very short term, we know that the actual market price is over here, so somehow it should decrease over here. And we also said that currencies earn interest over that period. So that means that if the interest is small, then the return that you're getting over this period is the return of both the market move plus the interest rate. And it ultimately gives you this kind of return. Now, this kind of return can't be in excess of what you'd earn by putting some more money in a deposit, because that would create arbitrage. So therefore, let's say that this is now in perfect equilibrium. We know where we expect the currency to come, and we've got these two returns, such that over this period, these two interest rate plus market moves gives me my sort of risk-free rate that I can get at the bank. Now let's say that the central bank comes in and all of a sudden says, well, I've just shifted my policy. I believe inflation is on the table. A classic example was January 2011. Jean-Claude Trichet came out after the great financial crisis. Nobody was talking inflation. He all of a sudden has a brainwave. It's inflation. Euro-dollar went from 120 all the way to 140 in the next 3 months. That's a big move. So now how does that manifest itself in this particular model? Well, all of a sudden, the interest rates, as we said, if banks change their policy or view of the future, don't just gradually change, they go boom. You know, all of a sudden people realize, oh my God, this guy's going to change in the next 3 months, interest rates over here. So if interest rates, let's say, go to 0 as an example, so the opposite in this particular case, then obviously the return I get from this currency has to compensate for the fact that I'm not getting any return on this particular interest rate. So therefore the change in currency is instantaneous, so that over the next 3 years, I can actually make that kind of return. So what you see is that this model about a long-term fixed point implies I have to have big changes right now so that I can actually, by holding this thing over the next 3 years, make up what I've lost on the interest rate. It's easier to draw on a blackboard, but the whole point here is that the long-term view that people have tends to amplify the very short-term reaction the currency has. So over the short term, the move might look exaggerated when you look at a daily chart, you look at the bar. But really what's happening is that move needs to be thought about as amortizing over a particular time period. And the only way over that particular time period I'm going to get that return is if right now it shifts. And so you need that instantaneous change. So that kind of model actually very nicely explains why you see volatility in the markets and why policy shifts in central banks are so relevant. And so this particular toy model was developed by a guy called Dornbush towards the end of the 70s, and he introduced it really with regards to trying to understand why is it that currencies are so volatile if the underlying fundamentals are not. And so a classic example in equity markets is dividends. Or not dividends, or just the value of the stock. So if the value of the stock is a representation of the dividend flow that I have, which is usually the kind of discounted cash flow model people have, and that depends upon the health of the company, well, how the hell can I explain that some companies do this, go from 50 to 100 and back down? I mean, the state of the company didn't change over 6 months like that. So there must be something else. Within equity markets, you can explain it via herd and crowd behavior and craziness. Dornbush tried to sort of explain it in much more rational behavior. How does a rational approach to the markets explain the kind of big moves we see? And it's all about perception of what will happen over the future. And if my central bank that sets interest rates has a shift in perception, that'll have a big effect over 5 years, and that effect must be captured right now in the currency markets.